This is Kenji Sinclair. Right now, gold is stuck, silver is stuck. Both of them slammed into a wall of resistance right after the best inflation data in months, and they didn't break it. Most traders are reading that as weakness. I'm going to show you why it's actually the opposite, and why this exact kind of boring, frustrating, sideways action is what shows up right before gold makes its next real move toward 5 figures. Here's what we're covering. 1. The exact price levels that are pinning gold and silver right now, and what has to happen for that to break. 2. The 100-year chart almost nobody's showing you, the one that compares stocks to gold, not dollars to gold. And 3. The math behind why serious money is still talking about $10,000 gold, and what that would actually mean for your portfolio. Let's get into it. So here's the standoff. This week's inflation print came in soft. Exactly the kind of number that's supposed to send gold higher, because soft inflation means the Fed has less excuse to keep rates high. Gold popped on the news, and then it stalled, right into a resistance shelf that's held for weeks. Silver did the same thing, banging against the top of a multi-month downward channel and failing to punch through. Here's the part traders miss. On the weekly chart, gold is still printing lower highs and lower lows, technically still a downtrend, even after a good news week. But zoom into the daily and the hourly, and the story changes. Buyers have already broken a shorter-term downtrend line. There's bullish divergence forming. Price is making a slightly lower low, but momentum is making a higher low, which is usually a sign sellers are running out of gas before they run out of room. That combination, bearish on the big chart, quietly bullish underneath it, is exactly what a bottoming process looks like in real time. It's not clean. It's not exciting. It looks like nothing is happening. But this is the phase where the setup gets built, not the phase where it gets confirmed. The confirmation comes later, and when it comes, it tends to come fast. Let's get specific about the levels, because this is where most of the noise disappears. On gold's daily chart, the nearest wall sits right around 4,075. That's the exact level that's rejected every push higher this week. Clear that with a real close, not just a wick, and the next magnet up is closer to 4,288. On the downside, the first cushion is around 3,757, but the zone that actually matters, the one buyers have defended every single time price has dropped into it this year, sits between roughly 3,560 and 3,640. Silver's fighting the same battle around the 5,750 level, exactly where a multi-month downtrend line and horizontal support are converging into almost the same price at almost the same time. When two different kinds of resistance line up like that, the breakout or the rejection tends to be sharper than usual. Now here's the piece almost nobody's talking about, and it's the real tell, the dollar. Forget gold's chart for a second and look at the dollar index. It's been holding an uptrend since the spring, and every time it's tested that trend line, buyers have stepped in to defend it. Barely. That's the whole ball game. Gold and silver aren't going to break out on their own. They need the dollar to roll over first. And right now, the dollar is doing exactly what a market does right before a bigger move. It's grinding against a level, getting defended weaker each time, like a wall that's been hit one too many times. Think about what happens the moment that wall gives way. Every trader who's been sitting in cash, waiting for confirmation instead of chasing a bounce, suddenly has a green light. That's not a slow trickle of buying. That's a stampede of sidelined money hitting the market at once. Because the sidelined money is bigger than most people realize. When nobody's buying, it doesn't mean nobody wants to. It means everyone's waiting for the same signal. And the dollar breaking its uptrend is that signal. And you can already see the cracks. The dollar's already given back its rally once this week. It dipped toward that trend line. Buyers stepped back in overnight to defend it, and by the next session, it was testing the exact same line again. That's not strength. That's a market being propped up out of habit, not conviction, and habits break. Here's where we zoom all the way out, because the daily chart only tells you what's happening this week. This chart tells you what's happening this century. Compare the stock market to gold, not to the dollar, to gold, and you get what's called the Dow-to-gold ratio. Back in 1980, that ratio was close to 1. One share of the index, roughly 1 ounce of gold. Over the next 20 years, stocks massively outperformed, and that ratio blew out to 45. Since the year 2000, it's been unwinding, hard. Today, that ratio sits around 12. Stocks measured in gold have already given back roughly 70% of that run. And this isn't a one-time event in history, it's the pattern. Every fiat currency that's ever existed has eventually lost the bulk of its value. Since the gold standard ended in 1971, every major currency on Earth has lost somewhere close to 99% of its value against gold. Gold and silver are really the only two monetary assets that have survived that process intact, simply because nobody can print more of them. So when analysts talk about that Dow-to-gold ratio falling from 12 back toward 1, that's not a wild guess. That's just the ratio finishing the round trip it's made before. And if it does, the math is almost too clean. A Dow around 10,000 and gold around 10,000. 1 for 1. That's where the five-figure gold number actually comes from. It's not a slogan. It's a ratio reverting to a level it's already visited twice in the last 100 years. Here's a strange but useful data point that backs this up. Go back 5,000 years, and a cow has consistently traded for somewhere between half an ounce and 1 ounce of gold through empires, currencies, and civilizations that don't exist anymore. Nobody can manufacture a cow the way a central bank manufactures currency. And that's exactly why gold has held on to the same kind of real purchasing power a cow has, while every paper currency in between has quietly been retired. Rome ran the same playbook we're running now, just with metal instead of a printing press. Roman coins started out close to pure silver, and over roughly 200 years, emperor after emperor quietly diluted them until there was almost no silver left in a silver coin. Nobody announced it. People just noticed slowly that their money bought less. That's the oldest trick in finance, and every currency since has just found a faster way to do it. Here's the part that should actually worry you more than it excites you. If that ratio reverts by stocks falling instead of gold rising, that's not a gold story anymore. That's a wealth story. Losing 70, 80, 90% of a portfolio's value isn't just painful, it's mathematically brutal to recover from. Lose 90%, and you don't need a 90% gain to get back to even. You need a 900% gain. The 1929 crash took the Dow 25 years to recover in nominal terms. Most people don't have 25 years to wait. This is exactly why the case for gold and silver isn't really a trading call. It's insurance. Priced in gold, a house that cost a few hundred ounces 100 years ago costs meaningfully less in ounces today, even though the dollar price went up 9 times over. The dollar number went up. The real cost, measured honestly, went down. That's the whole trick currencies play on you. Line goes up, purchasing power goes down, and most people only ever look at the line. One more data point on how stretched things actually are. Total U.S. stock market value compared to the size of the entire economy, a measure Warren Buffett himself has pointed to for decades, is sitting near 2.5 times GDP right now, a level this market has essentially never sustained for long. That's not a prediction of exactly when it turns. It's just a reminder that stocks are always this expensive is not actually true historically, no matter how normal it feels while you're living through it. And it isn't only stocks. The same overextension shows up in bonds and in real estate, priced at levels that only make sense if borrowing stays cheap forever. That's exactly why a genuine reset in that Dow-to-gold ratio wouldn't stay contained to one asset class. It would ripple through nearly every paper asset at once, which is a very different situation than the stock market had a bad year. So, what do you actually do with this? Not panic buy, not go all in on a single candle. The approach that's held up across decades is boring on purpose. Accumulate gradually, on a schedule, regardless of what the daily chart is doing, because you already know the daily chart is noise sitting on top of a decade-long signal. A common framework serious allocators use is somewhere between 20 and 40% of a portfolio in physical precious metals, built up a little at a time, not timed to headlines. Think of it like paying yourself a bill every month, the same way you'd pay a mortgage, a fixed amount, on a fixed schedule, regardless of whether that week's headline is bullish or terrifying. That's the method that actually survives a decade, because it never once requires you to correctly call the exact bottom. Inside that allocation, gold is the core holding, but it's worth knowing silver historically moves faster in both directions once gold leads, and platinum right now is trading at a steep discount to gold by historical standards, which is exactly the kind of gap that tends to close once metals broadly get moving. None of that is a guarantee. It's a framework for building a position methodically instead of emotionally. And whatever you do, don't build that position on borrowed money. Leverage is the one thing that turns a long-term thesis into a short-term disaster, because a market that's ultimately going your way can still shake you out first if you're forced to sell into a dip you didn't need to survive. So here's the whole picture. Gold and silver look stuck this week because they're pinned under resistance. But underneath that stole, momentum is quietly turning. The real trigger isn't gold's chart, it's the dollar's. And the reason serious money keeps talking about five-figure gold isn't hype. It's a 100-year ratio finishing a cycle it's completed before. The same cycle that's shown up in Rome, in every fiat currency since 1971, and in every asset bubble that's ever needed to unwind. If you want to see exactly how that dollar breakdown would play out and what it's done the last 3 times it happened, I break that down in the video right there on your screen. Watch that one next. If this helped you make sense of the chart, hit like, subscribe, and I'll see you in the next one.